Unless we have some pending doom in the next, call it 12 months, there is absolutely no need to cut. You're taking away bullets that you're going to need to fire in a gun when we have a real problem. It's nuts to cut rates.
What does it mean for the stocks?
So I agree with Kevin. I don't think you need a rate cut here. And I think when you look at the curve, the strength of the curve right now, the significant buying is in the 5-year. And to your point, that kind of tells me that, yeah, the street is desirous of this cut. We keep talking about inversion. But if you look at the 5 to the 30 or the 10 to the 30, that's actually steepening over the last 18 months. So that might be signaling a cut. I agree with you. I don't think the market needs a cut. The reason the market doesn't need a cut and why it might be good for stocks is because if you look back, the average 10-year in 2018 was 2.9%. Now you're getting relief as a corporation. What's the Fed worried about? The Federal Reserve is worried about corporate debt. That is going to contract profit margins. Now you're actually going to get a lift in profit margins for these S&P 500 companies because they're going to have a lower borrowing cost.
The economy's slowing. The question is how much?
As my friend Bob Weir sang, even a blind man knows when the sun is shining. And I don't know much, but here's what I do know. If the Fed gets around to cutting rates, you will not like the economic environment that is commensurate with that rate cut. The Fed right now is in a neutral, patient standpoint because it sees growth at potential. I believe you'd be talking about growth sub-potential, sub 2%, maybe towards 1% for the year. You would have a rising unemployment rate. You would have need a drastic change in the outlook.
Yeah,
for
you'd also,
the economy.
You'd also make
even from here, from the slowing, that's why I interrupted you, because even beyond the slowing already expected.
Well, you get to a point where, as Steve said, if it got to the point where the Fed had to cut rates, the market would have been acting badly also because the outlook for the economy would have started to get pretty dire that you would come to the point where the Fed would have to cut.
Sure. So in general, I agree with that. I do think that the yield curve inversion of last week changed the calculus a little bit. And that is why I think we saw the acceleration in the market's expectations of a rate cut. Because that inversion, the yield curve is something that we think the Fed is watching very closely. Now, I think it's important to talk a little bit about how the yield curve inverted, which sounds a little bit weird. But if you look at what happened last week, we had the short end of the yield curve remain relatively stable because the Fed didn't do anything. And in fact, they signaled a very dovish response. Right. But if you look at what happened to the long end of the curve, it was that 10-year that basically collapsed and fell out of bed because of very disappointing data out of Europe. PMIs from Germany and the manufacturing sector of the euro area. But I think if you look at prior inversions and prior cycles, the difference has been that the inversion has happened because of the Fed. The Fed has basically hiked to cause the inversion and then continued hiking right on through. So here you can see the Fed funds rate in red, and then the blue is that 10-year, 3-month Treasury yield. So we've circled where it's inverted, and you can see that where it has inverted in the prior 2 cycles, the Fed's continued to hike. So the Fed's response at this point is very important. We do not think that they're going to make the same mistake. I don't think that they necessarily need to cut. I agree with Kevin. The inflation-adjusted Fed funds rate is less than 50 basis points. It's hard for me to see that as overly restrictive for the economy.
For stock investors, Steve. Nobody knows exactly how weak the economy either is or may get. Nobody knows how bad our earnings could be, or maybe they trough in the first quarter and you get a pickup and then everything's great. You just can't answer some of these most critical questions as you try and figure out what the Fed's going to do next and what it means to the market.
And I think that's exactly the point. There is no, stated time and time again, there is no playbook for this. So you can go back, and it's instructive and great points you made. But the facts are that we haven't had bunds be negative like this for when?
Yep.
And
we haven't had global rates,
especially after a 20% move in the market.
Right.
It only muddies the decision-making process for the investor.
Right. So the knee-jerk reaction is if the Fed cuts can be good for stocks. I'm sort of with the camp here. If the Fed cuts, it's because things have gotten a whole lot worse. So they can talk about all the other policy tools that they have rather than low rates to make the economy go. Cash for clunkers, is it going to do it again?